This combination of rising prices and interest rates has had a significant impact on consumers. As vehicle prices have soared, individuals are forced to extend the duration of their loans to manage higher monthly payments. Consequently, the overall debt burden and the time it takes to fully own a vehicle have increased. Moreover, the rising costs and loan rates have resulted in more buyers being unable to enter the car market altogether. The reality is that car dealerships' strategy of inflating prices has backfired. Potential customers are hesitant to invest in these exorbitantly priced vehicles, leaving dealers with an overwhelming number of unsold cars languishing on their lots. It's worth noting that most car dealerships don't actually own the cars on their lots. Instead, they secure loans from banks to acquire the vehicles, making monthly payments until the cars are sold. However, in a recession, banks have become cautious about extending further loans to these dealerships. After all, how can dealerships sell their cars when customers are reluctant to make substantial purchases during an economic downturn? Even if dealerships offered the cars as collateral, banks aren't equipped to sell cars. Furthermore, the demand simply isn't there, with potential buyers tightening their budgets during tough financial times. As a result, banks have reduced their loan portfolios to car dealerships. For instance, Citizen Bank has downsized its loans from a staggering $14.5 billion to a mere $5 to $6 billion by the end of 2024. Other banks have followed suit, retreating from the uncertain fate of car dealerships. This financial retreat has far-reaching consequences, as dealerships are left stranded without the loans that once sustained them. The challenges don't end there. Interest rates are rising daily, making it even more difficult to finance car sales. In March, the average monthly payment for financing a new car reached an all-time high. Edmunds reports that people were paying an average of $730 each month to finance their new cars. Financing a used car has also become more expensive over time, with the average monthly payment increasing by $147 from June 2020 to reach $556 per month. Furthermore, a growing number of new car owners are making monthly payments exceeding $1,000. In 2019, only 5% of car buyers had monthly payments in this price range, but by 2023, that figure had surged to 17%. Buyers who opt for high monthly payments often choose shorter-term loans lasting 3 or 4 years, which require larger down payments. Though the number of these loans has increased, they remain a small portion of the overall market. On the other hand, the majority of loans with monthly payments exceeding $1,000 are taken out by individuals who opt for longer-term loans with higher interest rates. They stretch their loan term over a longer period, often up to 7 years, to secure a lower down payment up front. Buyers' reluctance to purchase vehicles stems from a combination of rising car prices, difficulties in securing lower interest rates, and the prevalence of longer-term loans. This trifecta has made car ownership less affordable and attractive. Dealerships face immense challenges in selling cars amidst these market conditions. However, amidst the gloom, there's a silver lining for potential car buyers, especially those with the ability to make cash purchases. Dealerships are desperate to offload their unsold vehicles, creating a favorable environment for negotiation. The next 60 to 90 days could prove particularly significant for buyers as dealerships become increasingly eager to move their inventory quickly. Seizing this opportunity can lead to obtaining a vehicle at a more affordable price. The impact of increased prices and interest rates has been significant for consumers. Americans are now extending the duration of their car loans to manage higher monthly payments due to rising vehicle prices. As a result, the overall debt burden and the time to fully own a vehicle are increasing. Moreover, more buyers are being pushed out of the car market as the costs and loan rates rise. Jonathan Smoke, the chief economist at Cox Automotive, emphasized that the pool of buyers who can afford new vehicles is narrowing. It's important to understand that most car dealerships don't own the cars on their lots. Instead, they secure loans from banks to acquire the vehicles and make monthly payments until they are sold. However, during a recession, banks are cautious about extending further loans to dealers. Selling cars becomes challenging when customers are hesitant to make large purchases in an economic downturn. Banks aren't in the business of selling cars, and the demand from potential buyers is low during tough financial times. For instance, Citizen Bank drastically reduced its loan portfolio to car dealers, cutting it from $14.5 billion to $5 to $6 billion by the end of 2024. Other banks have followed suit, retreating from extending funds to car dealerships. This financial retreat has far-reaching consequences, and it's a matter of time before many dealers face closure. Amidst banks tightening their purse strings, dealerships find themselves stranded without access to the loans that once sustained them. Adding to their woes, interest rates continue to rise, making car sales financing even more challenging. In March, the average monthly payment for financing a new car reached a record high of $730. Similarly, financing a used car saw a notable increase, rising by $147 from June 2020 to reach $556 per month. Furthermore, an increasing number of new car owners now make monthly payments of $1,000 or more. Back in January 2019, such payments accounted for about 5% of sales. However, by March 2023, that figure skyrocketed to 17%. Ivan Drury, the director of insights at Edmunds, explains that some buyers opting for high monthly payments choose shorter-term loans lasting 3 or 4 years. While these loans come with higher monthly payments and larger down payments, they remain a small segment of the overall market. On the other hand, individuals who prefer longer-term loans with higher interest rates make up the majority of car loans exceeding $1,000 per month. These buyers stretch their loan term, often up to 7 years, to secure a lower down payment up front. The combination of escalating car prices and difficulties in qualifying for lower interest rates has compelled buyers to accept larger monthly payments over extended periods. In 2024, only 1% of auto loans lasted 6 to 7 years, but now they represent 30% of the market. Conversely, merely 5% of loans are paid off within 2.5 to 3 years. These factors have led to buyers' hesitation in purchasing vehicles, causing challenges for dealerships. However, the current automotive market suggests a favorable time for customers, especially cash buyers, to make a purchase. Dealerships are striving to sell their existing inventory quickly, leading to potential price reductions. If you're in the market for a newer used vehicle and can pay in cash, the next 60 to 90 days present a significant opportunity. You can negotiate lower prices and secure attractive deals due to dealerships' urgency to sell. This can help you obtain a vehicle at a more affordable price. Now is the time to act and benefit from potential discounts and incentives offered by dealerships. In summary, the car dealership industry faces challenges like rising prices, higher interest rates, and difficulties in obtaining loans. As a result, car sales have declined, leaving dealerships with excess inventory and financial strain. However, with dealerships eager to sell, customers who can make cash purchases have an advantageous position to negotiate lower prices and secure attractive deals. The next 60 to 90 days are crucial for buyers to take advantage of this situation. By doing so, they can obtain a vehicle at a more affordable price. Despite the car dealership industry's tumultuous period, proactive consumers can benefit from discounts and incentives. Share your thoughts on these developments in the comment section below.